Welcome to Matt's Investing Corner, and today we're going to do something different. We're going to explain the PE ratio. PE ratio means the price to earnings ratio. It's a parameter which is quite often used to value a company. And this was something that was recently raised by one of my viewers, and he asked me, can you explain the PE ratio? And this is what we're going to do today. So as I said already before, the PE ratio means the price to earnings ratio. And in this video, we're going to talk about the following. What is a PE ratio? How to calculate a PE ratio? I'm going to give you an example calculation, why they differ across industries, PE ratios, and why what the range can be of a PE ratio per industry. So first, shout out to Minerva M, K2M, for the question. He said basically, can you explain the PE ratio and its implications? And that's exactly what I'm going to do today for you. So quite often I'm looking at different companies as well. And one of the parameters you may want to consider to looking into is the price to earnings ratio. And what does it do? It basically gives you an indication of whether the company is very cheap or expensive, or to what extent are the earnings and the price share related, and what is the ratio in that. And basically it gives you a price tag of the company, and it tells you how much you're paying for every dollar of earnings that the company makes, basically. So let's go through the formula. The formula is the following. So the PE ratio, price tag of a company's profits, is basically a formula whereby the stock price, so the price for which you can buy the company currently in the related index, you need to divide that by the earnings per share. And it basically says EPS TTM. So earnings per share, and that's over a period of 12 months, trailing 12 months, TTM. And when you divide the stock price divided by the earnings per share, you get basically the PE ratio. And that's the formula. Next, I want to talk to you about an example, and you might think, syrup waffle stand? Well, that's a hobby of mine that I one day will open my own Dutch waffle. They call it stroopwafel stand. But imagine, I'm just going to take you an example of that. Imagine I am in the market to buy a company. In this case, I might be buying a share of a company, and I want to know what the PE ratio is of a particular setting up a cookie stand for stroopwafels. Imagine I can buy a stand for 10,000, and that would give me, just imagine this would be the stock price. And the 10,000 would bring me 1,000 of earnings per year. My PE ratio would thereby be the 10,000 of the cost of the stock price divided by the earnings, and that would bring me a ratio of 10. So you're paying 10 times its annual profit. So the PE would be 10. Imagine I could also buy an already existing stand, and that stand would cost me 20,000. However, I know that they make around 500 a year, so my PE ratio would be 40. So the question is, with a higher PE ratio, does it make it more attractive? Why does it have a high PE ratio there? Well, it's more expensive per dollar for the profit. And would you be willing to pay for it? And there are some underlying items that can be hidden into PE ratio, and that's future growth. How successful is the stand? How many customers do they have? How much money are they gonna make? What kind of expectations are related to that? So it's basically a snapshot to compare companies and to see if the stock price makes sense based on its profits. So why do PE ratios differ across companies and industries? Well, there are a number of reasons why a PE ratio can skyrocket and go up a lot. One of the items is most obvious is when a company is having a very strong growth expectation. If they expect to grow further with the number of customers, that they have an innovative product that is very successful and everyone is basically buying it, and therefore it's booming in terms of a company. Their profits will go up tremendously. So huge growth expectations may have a strong impact on the PE ratio. So higher PE ratios basically give an indication that people have a high expectation of that company. Another thing is industry norms. So certain companies and industries are just very innovative and also risky. Just if you do a lot of research and innovation, you need to invest in that. It's not given that you will get a profitable business out of that, or that you deliver a product that is in high demand. But these type of companies, and I'm now talking, for instance, about tech or biotech, they innovate a lot. They do a lot of research, and therefore, normally their PE ratio is also higher. These companies are riskier, and companies with high risk and with stability have an impact as well on the PE ratio. So more riskier companies, they have likely also a higher PE ratio, because the more risk they take, the bigger the payoff may be. Another thing is profit margins, of course. If the profit margins are very attractive, if they have delivered a product that has enormous margins, and they're selling it tremendously, then the margins and the total revenue that company will make will have a positive impact on the PE ratio. Ultimately, the economic conditions. I can imagine that there is a new policy change or a new administration that wants to boom certain renewable energy or renewable cars, or wants to stimulate the chip industry. Well, if that's happening and they suddenly start to create a policy which is favorable for a particular industry, well, that can really cause that a particular industry is suddenly booming. And thereby also the company's value will be much higher, because they expect a lot of growth because of that. Next, I would like to talk about some example PE ranges per industry. And the first one is for instance, more like mature, stable companies, like a utility company or consumer staple companies. They normally have a PE ratio between 10 to 20. Don't ping me up completely on these numbers, but this is an average range, more or less. And you will see a lot of companies that range in these ratios where I'm going to refer to. Next one is growth companies, tech companies, biotech companies. They normally have a PE ratio between 25 and 50. And obviously, if such a growth company has suddenly made an innovation or a breakthrough, then suddenly this number of this PE ratio can even be higher as well. Next are cyclical companies, automakers, steel manufacturers. These are your traditional car manufacturers, and they have certain cycles per year, and they have certain PE ratio between 5 and 15. Next are value companies, traditional retail, old industrials. They have a PE ratio low in the range of between 8 and 15. And then next is the high growth speculative companies. They are at the early stage of tech. They are very innovative, and they can have tremendously high PE ratios. High growth speculative companies, well, let's take Tesla is one of them. They're not early stage tech, but they're innovating constantly, and they are producing new models. They're having new ways of producing, which makes it the production per unit super cheap. These kind of companies are the ones that are growing tremendously. I think another one is an Nvidia, a Palantir. These kind of ones are falling into this category. And the last industry is basically financial companies, banks, insurances. They are in a range between 8 and 18 normally in terms of PE ratio. Next, I would like to give you some examples of the PE ratios and where you can find that, for instance, in DEGIRO. What you can see here is I have my DEGIRO open and I have Amazon here. And if I go to Analyst Views, you can see directly that one of the first PE ratios that or parameters that they show is the PE TTM, trailing 12 months. So here you can see Amazon has a PE ratio of 34. Nike has a PE ratio of 21.52. If we look into an industry like the semiconductor, the chip industry, let's take 3 of them. The first one is ASML. ASML has a PE ratio of 32, which is relatively high, but it's a tech sector and a high innovation and high big margins are there, so that makes sense. AMD, if we go to AMD Analyst View, you see a PE ratio of 102, so that's quite high. One of the highest that we've seen so far. If we go to Nvidia, they have only a PE ratio of 37. So does that make Nvidia a better purchase than AMD? Well, these are the questions investors can start asking themselves. If we look into car industry, traditional car maker like BMW, PE ratio of 6. If we go to the Chinese upcoming is a huge electric car manufacturer, BID, we see a PE ratio of 26. If we compare that with Tesla, we can see a PE ratio of 131. So it says something about the innovation, about the future. The value of the price of the share represents basically what people are willing to spend on it. Another one that I want to show you is, for instance, Palantir. Palantir is currently you can buy for 84 and has a PE ratio of 447. So they expect a lot of profit, and this is already being priced into the PE ratio and in basically the share price. The PE ratio is one of the highest that we have seen so far, and this one basically fits this category of this high growth speculative company. It's far beyond the range of 50 to 100. And why? Because there's such an expectation around this company, and this share price also represents this. So PE ratio, main takeaway. Is it the magic number that tells you to buy or sell? No, it's not. It's a starting point. It's a point whereby you can compare companies, especially in the same industry, and you can start asking yourself, are they overpriced or are they actually a good bargain to buy? Is it? And this is something currently with these tariffs and with these correction that basically is happening. Some of these PE ratios really took a hit downwards and make it now very attractive to step into. So all in all, it's there to help you get a better understanding of the company in terms of their earnings and in terms of the share price. And I hope this was useful. And if you have any questions or comments, then please raise them in the questions below, and I'm more than happy to read them through. Wish you good investments and hope to see you in the next one. Bye bye. Take care. So as a beginner.